I want to share with you the 5 steps to finding the right location to invest. A lot of people ask me, like, how do you find these places where you're going to get good cash flow and good growth? Surely these are hard to find. Well, they are, which is why we've built robust systems and processes to allow us to identify the right place at the right time. Now, you don't have access to the same research methodologies we do, so I want to share with you just 5 key tips that you can use to try and identify the right location at the right time to invest. So, step 1, you want to look at the trend of sales. You want to see days of market decreasing. Now, a lot of people think, oh, we want short days on market. Personally, I don't mind if the days on market are currently long, 150, something like that, which might sound crazy. But what you want to see is you want to see that trend decreasing, because that's showing you that that is starting to tighten up. You also want to see yields increasing. So what that says to me, when I see yields increasing in an area, that says that people are starting to move to the area. Maybe there's new infrastructure projects going on. There's a reason for population movement, okay? When you start seeing yields increasing, that's the first sign that you're really going to start to see some market movement, when you start to see rents go up. So you also want to see vacancy rates decreasing. Now this kind of goes hand in hand with the yields increasing, because if you've got tightened supply and if you've got lots of people moving into the area, the rents are going to start going up, the vacancy rates are going to start going down. Now, what is a good vacancy rate? What do you look for? Well, a lot of people say less than 3%, and I agree. Anything more than 3% is, that you're going to be putting yourself at risk. But we're actually nailing areas which are less than 2, less than 1% vacancy rate, which means when you buy in that area, it's quick to get tenanted and you can demand a good price. Okay, now what happens after people start to rent in an area first? Because if they're moving to an area for a new job, they'll rent first to see if they like it, and then they'll go, great, let's go buy. Now these things all kind of happen fairly quickly. What you're going to start to see is you're going to start to see sales volumes increasing. Okay, so as you see days on market decreasing, yields increasing, vacancy rates decreasing, and sales volumes starting to increase, then you're going to know that you're in the right climate for all of this. It's this microcosm, it's this ecosystem of energy that's going on that indicates to you you're in the right place. Now, the problem that you need to watch out for though, and where a lot of people come unstuck, is you also need to look at the supply risk. Because you can have all 4 of those things that I just mentioned happening, but what is the future supply risk? Because if there is a new estate which they haven't started doing the land releases yet, or if there's big plans for new developments, apartment blocks, stuff like that, you're going to find yourself with a very short-term gain, if any gain at all. Okay, so you really need to take a look at what is the supply risk in the area over the short, medium, and long term to make sure you've got a good long-term investment. The 5 things again that you need to look out for. So days on market decreasing, it doesn't matter if they're long, okay? As long as they're trending downwards consistently. Yields increasing, rents increasing. You want to see vacancy rates tightening. You want to see days on market shorting. I think I mentioned that. You want to see sales volumes increasing, and you want to make sure there's a low supply risk. If you can get that right microcosm and then look at all of the long-term economic benefits in the area, you're probably going to find yourself in a good place. I hope that helps.